You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, it's Halloween, Friday, October 31st. That means it's time for a very special, seasonal episode of Blossom, of course, Volatility Views. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. No shortage of fun, spooktacular programs for you to enjoy on said network. Of course, you can find it all at the mothership, the website, as well as in iTunes, Stitcher, Aha Mobile, just about any podcatcher or service you can think of. I believe we're up on SoundCloud as well. I'm not sure if all the shows are there. I'll have to check. If you use SoundCloud, let us know. We can always add it. Of course, you can always find it via RSS, too. We can pull that into whatever podcatcher or player you like. And of course, we've all baked it into our mobile app for you guys as well to make it even easier. It's all available in one place on iOS, Android, and the Fire OS. So no shortage of ways for you guys to get your spook on this season with all of our crazy, spooktacular Options Insider Radio content. And joining me on this very special, very scary edition of Volatility Views, a man who's known to have scared a few children in his day. Yes, of course, I'm talking about Jared Woodard of BGC Partners. Jared, welcome back to the show. I hope you're not too frightened or too frightening.
I'm doing great, Mark. Thanks for having me.
I know it's a little spooky here, so just get your bearings. You know, it's going to be kind of hard, but we can handle it, I think.
This with the size of this rally, it's positively frightening.
Yes, you're right. This is in memory of what should be a vol apocalypse, but we're not really getting that. But we'll get to that in a little bit. First, let me introduce my other spooktacular cohort/co-host, fresh off of Options Oddities and ready to do some volatility viewing, Mr. Rock Lobster Andrew Giovinazzi, our editor-at-large for volatility and of course, unusual activity. Mr. Rock Lobster, welcome back to the program, sir.
It's a pleasure to be back on the Friday Spooktacular.
Do you feel offended whenever I call you at large because it make you think that you're a very large man?
Well, I'm tall. I used to be larger when there was some advantage to being, let's just call it girthier. But now I'm just kind of an old guy that looks at a screen all day. So no sense being too big.
Yeah, not much advantage in the old girth these days. You
know,
no, shove people out of the way to get to the walk-in broker.
Yeah.
Me too.
Exactly.
Out of my way. Add a teeny.
I need to be mobile now because I like to do other things. Yes. I like to fish and scrape barnacles.
Scraping barnacles takes a lot of effort. That'll burn off the girth.
It does. Right, you just do it once, kind of, and then all the barnacles are gone. Though, so it does make your triceps ache a little bit, though.
There we go. talking barnacles and triceps here on the old Volatility Views program. All right, with our spooky team assembled, don't worry, I've dialed back the spook a little bit, so it won't be too terrifying for the rest of the episode, though I can't guarantee there won't be a few other spooktacular surprises on the program. And meanwhile, we're going to keep on rolling right on into our Volatility Review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
Okay, a few more surprises. Don't worry. We won't have too many more. All right, welcome to the Volatility Review. This is indeed the portion of the program where we talk about the week that was from a vol perspective. Now that you're nice and awake, now that we've scared you, hopefully you weren't driving and didn't swerve off the road there. Let's dive into the week that was. We usually kick things off talking about VIX and all things vol, but because we are still kind of in the heart of earnings season here, it might be a worthwhile place to start actually looking at what's going on from an earnings perspective. And I know Jared is hard at work on that straddle study that I indeed contributed $5 to, comparing all of the recent performance of the S&P 500 names to their at-the-money straddles to see if they outperformed or underperformed, and doing some analysis therein. But there's been some interesting stuff cooking this past week or so from an earnings vol perspective as well. I think probably the top of mind for a lot of people was Amazon. They sold off pretty aggressively. They were off about 30 handles coming out of, I should say, their earnings. Even though going into the earnings, vol was decently priced. It was still expensive. It was about 47-point premium of implied over realized, which is actually not as much as you might expect going into an Amazon announcement, and yet still Apocalypse Palooza the following day. That's probably a lot of people top of mind when they're thinking about big moves, big vol from an earnings perspective. Jared, maybe we'll start with you. Anything really catching your eye over the past week or so from an earnings perspective and how it's performed versus implied versus straddles or whatever else caught your eye out there?
Yeah, we did see some big moves this week in social media stocks. I know LinkedIn reported Groupon, which isn't really social media, but it's kind of in that same vein of new e-commerce. These stocks had some really huge moves, and in a lot of cases, you didn't have outsized moves priced into the earnings, either on the basis of where implied vol has been historically or relative to what the absolute price move has been in the past either. In a lot of cases, both of those metrics suggested that the current earnings for the week the options were priced relatively low in the lower ends of those ranges for a lot of these stocks. And so when you did see the stock move in a big way, it meant that options traders, people who had bought the straddle or had taken an outright view, were much more likely to have seen some really significant returns than if they had been buying expensive premium in advance.
And Mr. Andrew, amidst all of your pit chatting and everything else you're cooking up over there at the pit, as well as doing all of your options oddities, anything really catch your eye from an earnings vol perspective?
For Amazon or just in general?
Whichever way you want to run with it, sir.
I thought we looked at the Amazon into earnings when we saw that. I actually thought there was some trade in there, kind of like flies versus, actually buying some downside flies. They were fairly cheap shots on the downside. You could actually pay for them by selling butterflies for credits on the upside, kind of a broken wing butterfly. We looked at that. It looked like fairly priced. Some of the earnings things, I guess we had Microsoft earnings last week. Like stocks like that paid the straddle. And LinkedIn, of course, surprising. Huge move, and the after just exploded up.
Yeah, it was funny because we were actually watching it live in the option block yesterday, and it looked like it was selling off for a while there, and then just the big reversey coming in and just saying, "Yep, surprise, head fake." We're going the other way.
And it was kind of like Amazon, right? Because I think Amazon has gained all the ground it lost. As in, we're just going to keep spending money, and people are giving that stock. They just give that stock a pass. It was what, $3.16? It hasn't gained it all back, but my gosh, it was trading 2 85. Now it's, almost 305. So they hate it, and now they don't hate it. And I think as far as from earning vol point of view, a lot of these names, even like Apple, for the most part, if you sold the straddles, you didn't do too well in a lot of these. So, of course, we'll see that long-awaited straddle. But I still think a lot of the volatility is underpriced for the earnings straddles. We actually go back. We don't look at directly like at the week of. It's more sort of the back month stuff. I think some of that volatility can get relatively cheap, and you get the earnings move as a little kicker. So, but I would just say, you've got to be careful. You have to be. It is selling all that high vol earnings is by no means easy money. It looks statistically cool, but as Jared well knows, the option model really was not made for one-day events, and it's not those. None of that price is very easy, or shall we say accurately, because it's just too much guesswork for one day.
Yeah, it's almost a definition of hard money when you're doing it that way. That's, if anyone who questions that should have been down on the floor when these guys were doing that going into expiration or earnings and seeing how many tums they were putting back and sweating profusely. And it's a rough way to make a living. You could do it, but you have to be okay with, I think, losing a few layers of your stomach lining in the process. But if you're okay with that, then by all means, enjoy, have at it. And you mentioned, of course, the selling premium wasn't the way to go. That seems to be pretty much the narrative this quarter, really, where the vol just wasn't really as inflated as we've seen in quarters past to make it really merit a sale. In fact, even going into a few weeks back, like Netflix, we usually see people saying, "Oh God, sell Netflix," even though it has exhibited a lot of vol in the past, and it is called the Widowmaker for a reason. But typically, we see the premium sellers attracted to that one, and even on that one, we saw the narrative kind of shifting. Where I saw a lot of people, writing into us or commenting on our various metrics or social media, saying, "Hey, I'm thinking about actually buying some premium in Netflix this time," which is relatively unheard of for a name like that. So it was an interesting cycle to watch. You mentioned LinkedIn, of course. We talked about them on the auction block yesterday. They're rallying hard today, up 25 handles or almost 13%. Nearly a 30 handle range from where they dipped in the after hours to where they're trading right now. Very aggressive. That straddle went out at $17 yesterday. So that was certainly a premium buying, volatility buying win. Starbucks also moving a bit. They closed yesterday about 77.5, a little bit off of that. That straddle going off at about 260, but not enough for the move, at least, to make the straddle pay off. Looking here at about $1.50 or so in today's activity. And of course, coming up next week, the mother of all crazy premium names is, of course, Tesla. They'll be coming up next week. We don't have the pure numbers next, of course, because it's not till the 5th. But the weekly straddle looking at about a $22 move they're pricing in right now, which, given what we've seen in Tesla, that may actually be a bit conservative. That works out to about an 85 vol if you're playing the home game. I hate to use the term vol in anywhere in conjunction with weekly options because it's not vol, it's all gamma, it's all decay. But c'est la vie. That price is out at about an 85 implied if you're paying attention to such things. And since we're going to move on in a minute to the broad stuff, let's look at who also reported this morning. Very important to the volatility sector. This is indeed the CBOE, the one name that has been doing well in a morass of pretty much weak volume across the board, except for the past month, excluded, of course. They reported their earnings this morning, and market kind of shrugging it off, trading 58.5, roughly, pretty much unched on the day. Given the fact that straddle went out at about $3 last night, not a bad premium sale, all things considered. It's off about 2 cents on the day, so you're probably pretty happy with that one. And since we're talking CBOE, let's keep on rolling right on into VIX land. It was an interesting week for VIX Cash as well. Had about a decent range, nearly 18 on the upside and all the way down to about the 14 handle, 14.05 or something in that range on the low side. Trading today pretty much unched as well, even though the most of the market is up substantially. The Dow and S&P up nearly a full percentage point. The Q's up 1.2% on the session, and the VIX Cash, even though the market is rallying, is pretty much unched off about not even a fraction of a percentage point here today. So not much going on. VIX Cash at all, hovering right around the 14.5 level today. So let's move on to our broader volatility view. Mr. Jared, we'll start with you. Anything from a VIX Cash or SPX implied vol level that really caught your eye in the week that was?
It was another decline over this week in vol overall, as the market surged now on Friday to new highs, and people are cheering on the indexes. Economic data came in so strong this week, from GDP to even starting to see some positive movement in U.S. wages now. On Friday, you just had the sense that with earnings coming in fine, in some cases good, with economic data so strong and markets rallying, there just hasn't been the same kind of justification in the minds of many investors, I think, for buying a lot of premium and a lot of protection. If anything, people seem to be just as interested in positioning using options for upside as they are for downside. So that's not an environment that's going to be supportive for the level of implied volatility.
And Mr. Rock Lobster, same question for you. What caught your eye in broad VIX land over the past week?
I've got one little pause for what my biggest thing with VIX land was. At the beginning of the week, we had this huge spike down in vol, like from almost 16 to 14. I think it was on Tuesday. And, in my head, I just could not, I was surprised. I had kind of a slower move sort of mapped out for VIX. A little lower. And, and I get a little particular with my volatility calls. I don't like being wrong. It happens. But I was right on direction, just wrong on speed. I'm like, how could they take the vol down this fast? Like prior to the Yellen leaving QE scenario, right? Because I figured if they pull QE and it's all done now, the market becomes maybe a little more volatile. That was my thinking, because kind of that the Fed put, or the Yellen put now, I guess, because it's her put, to wield as she chooses fit, is gone. And I thought that would lend to more market vol. And yet they sold it down hard at the beginning of the week. So I drew two things from that conclusion. One is I think we can see the 13 handle in VIX, which I thought would be tougher at the end of this year, but I think we'll see that. But I also think the range of volatility for us, I think moving forward, is going to be, I think we're going to see some more volatile swings. I think we're going to see replays of what we saw, maybe not to the extent that we saw a couple of weeks ago, but since when you think of it on the face of it, there wasn't really any, let's just call it, fundamental news that drove that. The euro's not growing, or the eurozone's not growing. I don't think that's a surprise for anybody. But how fast we got the market to sort of crater and then just bounce right back. So I think we're going to see some of that type of volatility again. We will see it probably in the next 6 months, because we'll still have, Europe will still be shuffling and struggling, and there will still be, and those governments won't be doing what they need to do, which is kind of restructure how they do stuff, which is painful for politicians everywhere to do. But that, I think all of that has, it puts sort of it gives vol, let's say, a wider range. We've had relatively low vol for a while because there's been a lot of certainty about U.S. policies. Whether you like them or don't, it's kind of, that's the way they were going to be, and they weren't going to change, and the market likes that. With the Bank of Japan now, I don't know what they're doing. This morning they're buying stock, or they are actively trying to destroy their currency, I guess. I don't know how that can be not add to the volatility in the longer term for us. I just think we're going to see everybody will be giddy for a while, and that could crush vol pretty low. And then everybody's going to freak out because all these monetary fixes end up just being sort of just temporary, wallpaper to whatever, real economic issues you got to deal with. I think part of that today, that's why the VIX is down 12 cents. I have VIX down 12 cents and implied volatility up in almost every option class in the S&P 500. And you ask, how can that happen? Well, the VIX is built to decline as the market rallies. because of the implied volatility skew. But if implied vol actually goes up for the options, the VIX level actually doesn't decline or doesn't decline at all. That's where you can get like a rising market and a rising VIX because the IV goes up. So there's a couple components to the VIX. And that's what we're seeing today. Just the market is moving so much and the realized vol is relatively heavy. I mean, a 1% gap, that's pretty, I can see us gapping down 1 or 2%, but a 1% up gap, like, oh, there's not enough stock in the world to buy. Everybody's freaked out, you know? So anyway, that's causing a lot of realized vol. And ultimately, I think that's what we're going to see going forward. We're going to see more realized vol because of, you know, for whatever reason, there's divergent central bank policies. The U.S. definitely is getting off the train, and the other countries that are a little slower to get their act together are staying on it. And that's going to cause, I think, our equity market to have, it's still good for the U.S. The fundamentals are improving and stuff, so that's generally good for stocks, right? But we'll have a lot more chop in the meantime.
That's a good point about, you know, the realized versus the historical here, because, you know, it has ticked off a bit in the broad S&P. We were trading around a 20 from a 10-day realized vol perspective just a few days back, and it's creeped off down to about a 13 or so now. Of course, given today's move, we might see that change yet again. Remember, upside moves, that's vol too. It's not just the downside, even though everyone who watches VIX only pretty much thinks of downside as vol. And speaking of the realized versus the implied there, Andrew, our old friend Don S., former co-host of the show, always likes to write in with some ideas and suggestions and opinions. And he made an interesting point he sent over before the show that's worth mentioning here today as well. If you're looking at, you know, the VIX product over the past month from about September 30th to right around October 29th, so pretty much 21 trading sessions in that range, the VIX is, if you looked at it just close to close, you'd think not a heck of a lot happened. You know, it opened at 16.31 VIX cash and closed at about 15.15. So not a heck of a lot, about a point and a sell-off in a month that is one of the more extreme months we've ever seen from an options and an underlying volatility perspective. And of course, if you looked at it from a pure realized perspective, and of course that's what those guys do over there, member of Volex fame, still working on some different realized volatility products, hopefully will be coming to the market shortly. And during their calculations, which is indeed a proprietary calculation, I encourage you guys to look up Real Vol if you want to see what actually goes into their calculation. But their product actually doubled over that period from about a 9 to about an 18. So if you're looking for something that actually exhibits some movement, that might be a place to look. And of course, you can replicate the realized vol in the marketplace as well while you're waiting for those products to come online with a lot of the techniques we've talked about here on this show in the past, dynamically hedging straddles and things like that. I know Don's going to write into me now and say that's not a pure way to do it. And of course it isn't, but it's probably the best way you can do it right now in the short term. But still interesting to see the way different products and different ideas are playing themselves out in this crazy, crazy month of October. And Mr. Jared, I know this probably is of interest to you quite a bit. What's your take on what we've seen, what Andrew just said about the way VIX is performing in a somewhat bizarre fashion, as well as Don's points about the discrepancy between the realized and implied vol out there?
Well, I mean, I love this argument that Don makes all the time. I mean, it's true. It's not even up for debate. It's a calculation issue that what you really care about is actual volatility, real deviation from the mean, then a product that's based just on implied is never going to be satisfactory, but just by definition. And so on that point, I think that there's not even that much room for argument. And so something that can replicate realized volatility for an investor who's really concerned about that is going to be potentially more attractive. And I think that the bigger question there is, should someone be concerned about actual volatility, actual moves, whether they're up or down, rather than just the typical investor behavior, which is exclusive concern with downside risk? And I guess a lot of that depends on your investing time frame and horizon and the mix of assets that you're in. But I got to say that I think that one thing that I would take and agree with from Andrew's comments earlier are that the environment over the next 1 to 5 years, I think, looks just as cloudy and unclear as anything in the last 5 to 10 years. I mean, the risks are different and the mix of risks is different. But in fact, there's less clarity about U.S. policy than we've had for at least several years with the end of QE. There's less clarity about how central banks and fiscal authorities as well around the world are going to behave. There's geopolitical risks that we weren't thinking about a year or two ago. And so in that situation, it's not just a question of stocks going up or down. It's a question of what asset mix is the right mix going into the near term. Because you can't make a case to be in bonds or be in, international equities without some view about what your expectations are for a lot of these different scenarios. With that said, I think that there's also some potential missteps that we can avoid pretty easily. And I think that as we think about the end of at least the large-scale asset purchases, even though QE technically continues, as the Fed has to decide either to roll or let their assets roll off. I think that one lesson is if you think back to the beginning of quantitative easing, or at least even back to the beginning of this third round of it. Every time the Fed has announced these kinds of actions, there's just this massive chorus of skepticism and criticism from people warning that this is going to lead to unintended major risks. This is going to lead to hyperinflation. This is going to cause gold to be the best investment ever. And none of those real dire warnings or none of that hand wringing ever kind of really bore out anything. It just kind of created incentives for investors to lose money. And in fact, I think it's if you want to argue that QE on the whole did absolutely nothing and spend a lot of time going through the economics of that kind of a claim, I think that's maybe worth stopping and at least giving it a hearing and seeing what the evidence is. But I think that the weight is at least tilted in favor of the fact that the Fed's been able to stimulate the economy at a time when the fiscal authorities refused to and actually acted as a drag. And so as a result, we've got real, traceable, obvious improvement in the real economy in the United States as a result of policy decisions that a lot of people regarded as disastrous or reckless or crazy. And now that Japan is trying something similar, a little bit certainly more aggressive, both in terms of size and in terms of the asset mix that they're using, it is a more aggressive proposal. But I certainly wouldn't want to see the same folks in the media or in investment managers and commentators who were so skeptical of QE. It seemed like it would be a real shame not to learn the lessons from that program and turn around with whether it's Japan or if Europe becomes more aggressive in the near term, and turn around and apply those same mistakes in those countries. It matters how aggressive these authorities are, but I just think that with the end of QE, it's a good time, I think, to step back and try to learn what we can from it, and use that to think about central bank policy in the future. And in Japan today, with the announcement of kind of a surprise, real announcement of more monetary stimulus, we're seeing exactly the kind, I think, of response that Andrew mentioned that I'm talking about, where volatility can act in ways that aren't always obvious. Because this announcement from Japan wasn't at all expected, the market hadn't priced in this kind of a move, and as a result, instead of the kind of volatility crush, implied volatility crush, I should say, in the options that you might associate with earnings or with some expected event coming to pass, instead we've seen implied vol spike higher, even as stocks are rallying higher. So this is one of those situations where the option implied vol moves higher, and the VIX equivalent for Japan, VNKY for the Nikkei, is up about 5.5 points today. So that's a situation where you see people repricing options, including allowing for much more significant upside, even as stocks start to rally. And I think a lot of that has to do with some of the idiosyncrasies of the Japanese market, some of the structured flow that creates some more gamma in the wings than we might have in the United States. But nevertheless, I think there's some really interesting incentives there, and that it's a much more interesting, much more an environment in which you have to be more tactical than, I guess, all-time highs in the Dow Jones on the surface would seem to suggest.
We'll get into a lot of that in the other part of the volatility review as well when we get into some of the commodity pricing and, of course, with Fed action and its impact on gold, and perhaps what your friend Mr. Greenspan alluded to in the market's resulting shrug, perhaps. But just as you're talking, I was pulling up some of the skew numbers here for what we're seeing on the yen versus dollar out there on the options, and man, it's pretty flat across the board. You get into the near term, the options that are set to expire pretty soon, and it is palooza. it is just pretty much as vertical a line as you're ever going to see in any sort of skew chart. So it's just crazy town out there, and it's very, very interesting stuff to watch. We'll get to more of that in a little bit. Meanwhile, let's move on into some of our other. We're finish up here with the VIX land, of course, VIX options. Trading it up yet again. Today, actually, a bit of a weaker day, only about 200,000 contracts going up on an ADV of about 670. We've seen multiple 1 million plus days in the recent weeks, listeners. So today, a bit of a shrug from an overall volume perspective. Looking at what was hot from the week that was from an overall VIX hot strike perspective. Nov 20s coming in on top these days, have been displaced. Our old friends, the D's 13 puts dropping all the way down to number 4. Nov 20s, 375,000 contracts open on that strike. Coming in number 2 at the Jan 20s, another very popular hot strike, 215,000 open there. A nearly 160,000 contract swing between the number 1 spot and the number 2 spot. So a lot of love on that Nov 20 strike. 213,000 open of the Nov 17s, taking up number 3. Number 4, our old friends, the D's 13 puts, still holding strong in the top 4 at least, with 211,000 open. Down to the Nov 25s, a little bit more optimistic there. Number 5, 208,000. Then down to the Nov 15 puts with 170,000 contracts open there. And then the Nov 14 puts, 164,000 contracts open. So three put handles coming in on the top 10 this week, which is very, very interesting. Nov 22 is number 8 at 157,000. Nov 18 is number 9, 147,000. And about the same, 147,000 as well for the Nov 21 calls, taking up the number 10 spot there on the list. About 6.5 million contracts open net on VIX right now, about 4.5 million of them coming on the calls, and just a hair above 2 million on the put side. So a little bit more put love coming in, which is also very interesting to see, particularly now that we're getting back down to some of those more low ranges than back when we were in the 31, 32 almost range from a VIX Cash perspective. Before we move on to some of the related products, Jared, anything catching your eye out there from an OTC vol perspective this week?
Yeah, the S&P variance swap market was fairly quiet relative to, I think, longer-term averages, but we did see a real pickup in activity late yesterday and then today in East Asia. A lot of the trades today, at least for Asian markets, were in Japan, as you might expect. So some folks trading variance there as the market has really moved. Otherwise, nothing too notable catching my eye other than some of the usual hedging activity and flows of that sort looking into 2015 and further out.
Speaking of products that perhaps are underperforming today from a volume perspective, it's our weekly check-in on good old VXXT, of course, the short-term VIX. We talked recently how just last week, actually, it was doing some surprising volume. I believe about 2,000 contracts last Friday. Today, not so much. Today, only 145 contracts going up out there. That's on an ADV of about 850, an open interest of nearly 5,000 contracts. So there have been a few robust days over the past few weeks to contribute to some of that open interest. Yesterday, the 30th, they did a whopping 6 contracts out there in VXXT. So not the biggest day. Of course, last Friday did about 2,000 contracts. And then this week, actually, on Wednesday, they did about 1,000 as well. That's the biggest day of the week so far. And, of course, the number one position out here in VXXT, the November 5th expiry, 15 calls with 1,000 of those open. And that's pretty much where that 1,000 lot went. Pretty much people gobbling up 1,000 of the no 15 calls. And that's pretty much it. The rest of the top 10 are pretty much unched. The a little bit longer out in Nov, expiring on the 19th cycle there, 18 calls, 900 of those open. And they pretty much drop off from there, 500 of the Nov 24s and 19s, et cetera, all the way down to about 200 open on the number 10 strikes. Not a heck of a lot open. Like I said, about nearly 5,000, just a smidge under open from a VXXT perspective. It is still kind of a coin flip what moves this product and which days it's going to get some volume and which days it isn't. It still is a bit of a head scratcher. I don't think anyone has really cracked that mystery yet, including the CBOE, who are all over there still wondering, hey, when is this product really going to either catch fire or just sink, one or the other? It hasn't really done either. It's kind of just floated along. Days like today are a little bit more towards the latter, but it has had enough surges of life to at least make it interesting. Moving on to some of the other realms we like to keep an eye on here on the old volatility review. Let's start off here in another one that's been very popular for a lot of you guys of late, of course, crude and the energy sector. Crude, yet again, still pretty much very similar from a volatility perspective to what we saw last week. Looking here at the old skew chart across the term structure for American crude oil here, a lot of them vacillating in the lower range of the 80 handle range. So we're getting pretty far down there from a crude perspective. This dollar move today not helping that, taking on the chin a little bit again today. And not surprisingly, we're still seeing a very, very put heavy skew out here with some of these put wings getting up into the 32 and 34 vol range for some of these premium puts to the downside, getting down into the 70 handle striker. So I'm not sure if a lot of people are really that concerned about as aggressive of a move, but still, the premium here speaks otherwise, that people are willing to pay up for these puts these days. Kind of a bit of the opposite, a bit of a flipping of the script when you look at some of the other energy products like nat gas, of course, still very predominantly call heavy. It's kind of the way that product tends to trade for the most part. You're hovering in about the 360, 370 range out there right now. And so that's where a lot of the interest is for this product. And of course, to the upside, these call wing getting a huge bump as you get up into the 4.5 and 5 handle range, where you get some serious premium going into some of these calls. Weird paper all across the board. Mr. Andrew, I know you don't watch the futures options as much, but you watch a lot of the ETFs that play out there. Anything really catching your eye this week from an energy vol perspective?
Yeah, I thought the kind of the flattening out of the upside in oil was a little telling. It's just like in the goofy USO. Paper-wise, they're not looking for a snapback in the price of oil anytime soon. Okay, we're not worrying about the price of oil going up anymore. So, normally when then all of a sudden there's a huge bid on the downside, it would not surprise me if we saw some lower prices for oil. I still think that the move from like the $100 range to this $80 range was kind of stealthy and quiet, right? As in, was there any, and Jared follows this stuff closer, like the macro type stuff, but was there any big, announcement that we're making more oil? Nope. It just all of a sudden the price disappeared. And to me, normally that usually means there's more of the same to come. It's when it's kind of quiet and just sort of a slow crank down. Those are kind of the scarier. It's scary. I don't have any oil position, at least right now. But I was looking at one today in our chat, which was kind of a funky back spread where, you're buying puts in a USO kind of at the money and buying an upside fly in case the price went back up. But it was the position was geared toward the downside for the most part. And if USO trades 29, would not surprise me at all next week, just for no particular reason, because whatever are the forces that cause oil to quietly slide down, I don't think any of that has gone away. So usually I need to see some kind of reason for things to stop whatever activity they're doing. And I don't think we've seen that yet. So if we slide down and, hit the 70 handle in oil and it kind of sits around there for a while, would not surprise me at all. Daily production just went up huge coming out of the U.S., and they seem to be solving all these bottlenecks by throwing oil and getting the trains flying everywhere they need to fly. So why can't we have a $72 or $73 barrel for oil?
The put skew would certainly tend to agree with you there, Andrew. The people are certainly, at the very least, a bit concerned about that right now. And, of course, OVX, our friend, which is the USO vol index, the vol VIX, if you will, for oil, trading right around a 31, has had a nice range over the past week or two, gapping all around the 30 handles and then down into the high mid-20s and back up into the 30s. So it's been an interesting time. You can probably spend all day parsing the nonsense that is USO. Instead, we'll move over to Jared. Jared, what's your take on what's cooking out here in the crude, or perhaps USO or whatever else catches your eye out here in energy land?
I think there's two interesting things going on. First is in terms of the underlying. It may be that we're hitting a point now where at $80 a barrel, the demand curve kicks in and people know that there's going to be a little bit more demand than there would be at 90, and so you've got a natural floor, I think, in the price, and there's also the fact that a lot of the real concern for crude oil in the last several weeks was about what this would do to U.S. production, especially in shale production and some of the Canadian tar sands and other areas where the costs are higher. And I think that investors have figured out now that the marginal cost for a lot of these producers is actually still a bit lower than this, so they can still be profitable even if they're a little bit less profitable with oil roughly in this range. Saudi Arabia hasn't really made any new waves. They have a meeting coming up in a little while, but in the meantime, it looks like I think a lot of that downside risk that we saw was investors kind of anticipating a Saudi put that had expired without anyone knowing. I mean, we've seen Saudi Arabia be kind of the swing vote in past situations, really the last several years. And this time it looks like the Saudis decided that put had expired, and they weren't going to be the ones stepping in to reduce supply or to increase prices either way when the market really kind of got full. But now that we've kind of adjusted to that new reality and found that domestic production is not as threatened as I think some people had feared, then we've seen oil trade a little bit more in a range-bound fashion. And the second thing I would point to in terms of the options market is a little bit of a normalization in the skew curve. It's still equity-like we've been mentioning in the last several shows, but just in terms of the current option prices compared to where they were 1 week and 2 weeks ago, the biggest change between today and, say, 2 weeks ago that I see is actually an increase in the at and upside call premium. So, for example, 110% moneyness options on crude oil futures have actually increased over the last 2 weeks, almost 2 points relative to where they were at that moneyness level 2 weeks ago. And that's true to a smaller magnitude, but the same notion all the way down to at the money levels of implied vol. So that tells you that investors are pricing in more upside potential than they had been, and that they're adding a little bit in terms of expected probability to the upside for crude, and that's also expected, I should mention, in analyst forecasts. Most analysts have a target range for the first quarter of next year, with I think the 75 area as certainly a lower bound, with lots more upside potential in those forecasts. And so I think taking all that together, I think it makes the case for some evidence of real normalization in terms of expectations, but with these premiums still very elevated compared to where they were a month ago, I think actually the case for being short vol in crude looks just as attractive now as it did, and probably more attractive in some ways than it did 1 or 2 weeks ago. So that's something maybe investors want to look further into.
Yeah, that's 10% upside move seems to be corroborated here by the charts we're looking at here, where that inflection point is hovering right around a little bit more than that 10% move to the upside. It seems to be where the inflection point is in the call wings, right around the 90 handle. We talked about that before. That seems to be where some of the interest comes in and speccing or hedging up to the upside. So that would probably that would dovetail with what you're saying there. The 2% or so increase in that 10% move to the upside certainly seems like the vol is bearing that out here. Speaking of, perhaps on the other side of that coin, the vol bearing out not what you expected at all. We touched on the Fed and everything else before, and of course, Greenspan making himself known yet again this week, coming out in a relatively unexpected fashion for him. He's not that demonstrative on big, grand, sweeping statements, rational exuberance notwithstanding, coming out this week and pretty much talking up gold like it's going out of style. You'd think he had quite a few calls in his back pocket, and hopefully he didn't. Hopefully he had a bunch of puts, because ever since he started talking up gold, it has just been taking it on the chin. It's down another, about 2% or so again today, and just taking a beating. And if it's funny, if you look at the longer term skew chart here on gold and the gold options, for longer term, it's relatively even keel. It's relatively flat. There's a little bit of premium to the upside and to the downside, but no demonstrable, real strong lean. And then until you get into the really, really near part of the curve here, which is, of course, the Greenspan effect, and just the puts catching some love out here, perhaps no small part due to our friend Mr. Greenspan talking up, but in fact talking down gold pretty dramatically. A little bit of a different story out in the other shiny metal, silver. We talked about this before too. Kind of a surprising bit of downside love out here for silver, with most of the months in the term structure reflecting a very, very pronounced put-heavy skew out here, which wasn't the case just a few weeks back. It was very, very pretty much back to that regular smile shape where it usually tends to trade, and now we're seeing the puts also getting a lot of love out there, which is equally interesting, perhaps not as Greenspan driven, but still very interesting. Also a little bit more equal across the curve, not just in the front month where we see that sharp gap. Mr. Rock Lobster, any of your mentees out there really playing hard in either GLD or SLV options these days?
We did. I couldn't help that. Actually, just prior to the option block on Thursday, we again, like, we do a lot of funky back spreading. I know. Buying premium type trades, but they also have a short premium component. So we bought a long time spread in gold, but we also bought just at the money, just out of the money puts on Thursday. And of course, that position just totally exploded in our favor today. It was a nice gift. I have to thank Mr. Greenspan for contributing to the wealth and happiness of the option pit clients in our chat room. So
there you go. He's doing his duty for God and country.
Exactly. And it's when Jared was talking earlier, people were bidding up gold on the QE thing. All right. QE's over. Now the Fed has a huge balance sheet, and I've got no clue how that's going to affect the world in the future. I wish I knew, because since it's never really happened before, we don't know. My sense is somehow long-term, that should be good for gold prices. However, with the whole QE thing gone, and probably the whole basis for a huge rally in gold just has basically stopped happening, where does gold go back to? I don't know. One, does it go below $1,000? I don't know. I mean, we broke the 1,200 handle pretty easily here. Do we go below 11? Do we go below 1,000? Why not? Because if we're not going to be in this huge, if what was supposed to cause some sort of inflation bubble didn't, and now it's over, what are the salient reasons for speculating in gold if you don't need it, for an industrial thing, or because you make jewelry or something? So I think that there is a case for gold going lower, and I think that's kind of what the skew's saying now. They're like, well, wait a minute. Why do we have to be up at this level? And again, those are production issues. I mean, take a look at the gold miners. They're not doing too good either. So there's not a lot of, I would not be walking around these industries with a catcher's mitt. Not quite yet. That's all I'm going to say real simply about them.
I will say that it's been a while since I've seen this much of a pronounced fading of a former Fed chairman. It's just playing out so demonstrably in the marketplace. The marketplace pretty much resoundingly saying no. You are not correct. We are taking this down, and taking it down hard. Mr. Jared, what's your take here on what's going on out in the metals land, as well as the markets fading? Your friend, your colleague there, your good buddy, Mr. Greenspan.
I don't have any particular feelings, or let me say this. I always at this point in the show mention how I don't understand the fundamental case for gold. I'm not sure that there is one or ever has been, and so on. And I don't want to repeat that broken record. So instead, I want to make a recommendation, which is that for people who are interested in gold and interested in thinking a little bit about it, I want to recommend a series of pieces. I think it's from last year, that Isabella Kaminska at the Financial Times wrote about gold, and really it kind of expands much more broadly beyond just that topic. But there's this phrase that she used a couple times that always stuck with me, calling gold the rate of reburying trade, something like that. And the gist is that when you think about what happens in the gold market, someone gets paid, convinces investors to pay them to dig around in the ground until they find the right sorts of minerals, and then they pull it up and they kind of clean it up and show it to people in some fashion, and people go, yep, that's the right kind of mineral. And then they or someone else in turn convinces sometimes those same investors to pay them to put it back into the ground, except this time in the form of vaults or some kind of secured other facility. So you're basically paying someone to go down in the ground, dig up some stuff, and then put it back in the ground and make sure that it stays there. So at no point, if you just think of that as a cycle, at no point does any productive welfare or utility enhancing behavior take place. And in fact, it's really the same sort of activity that Keynes described as something that a fiscal authority could do if you needed to generate economic activity, potentially useless economic activity, but activity nevertheless. Except the irony, the supreme irony of that fact is that the gold bugs, the people who are so passionate about gold and precious metals, are probably the last people on earth who would ever want to hear themselves described as enacting or carrying out with their money, something useless and Keynesian, certainly. So I just mentioned all that because I was talking to someone about that this week, and it just struck me how perceptive and insightful I thought that Kaminska's series on this was, and just the basic notion that, in fact, all the other financial assets that we have in the world are linked in some way to activities that we take to be mutually beneficial or welfare enhancing in some capacity. Gold is kind of like the ultimate antisocial, anti-humanist sort of, I'm going to take my toys and bunker down and screw all you guys kind of a trade. And I think that's probably the reason why some people love it, and then I guess the rest of us are at the very best kind of indifferent to that sort of approach. I could be wrong, as always. Happy to hear counter arguments, but that's my take for now on gold.
52 minutes in before our first mention of Keynes here on the program today. So I tip my hat to you, sir, for your restraint, Mr. Jared. All right, and that's going to bring a screeching halt. Once we throw out Keynes, it brings a screeching halt to the Vol Review. But don't worry, listeners, it's time for you guys to get some shine on the old program. It's time to dive right on into the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
A little bit of extra spook here on our Halloween episode of the old Volatility Views program. Time to crack open the old Volatility voicemail, see what you folks have in store for us. First one comes from a listener, goes by the handle Phillipono, and he writes, or perhaps she, shouldn't assume, are there any good tools out there for comparing realized to implied volatility and determining the best times to sell premium? Well, there are a legion of those types of tools. We've discussed many different ones over the years now here on this Volatility Views program. I know if Don was on the show right now, he would be screaming at me to mention one of his favorite tools, and that is probably one of the most basic ones out there that you can use to do this. It's available on most brokerage platforms. You can even just search for it online. They're called volatility cones, and those are, think of them as essentially your Bollinger Bands for volatility, where they show you where your vol mean is and where the one standard deviation, two standard deviations, up and down type moves are. So you look at where your implied vol is on that chart. That'll give you a good, at least, frame of reference for where you're trading in relation to the history of that product. And so if you see you're trading 2+ standard deviations above the mean, maybe you think twice before you buy that option, and vice versa. If you're 2 standard deviations below, maybe you think twice about selling that option. Doesn't mean you have to do that, but it at least gives you some frame of reference for where your trade falls historically. And of course, a lot of brokers have adapted that volatility cones tool and built it into their platform. They may call it something different, but there's a lot of different ways to break that down. But that's one of the best and most basic and pretty much widely available tool you can use out there without having to shell out a lot of cash to go to some of these other big platforms that offer more premium type stuff. That said, Mr. Andrew, do you have any premium type tools you want to recommend here?
Well, I have a couple. I developed one. It's called Option Vision, and that's available. I think it's a pretty great tool for looking at comparative realized vol everywhere.
How did I know you're going to plug that one? If people want to find that one, where do they go?
I don't work for the company anymore. It's www.acumen.com, and you can AQUMIN.com for that product. And number And also, I like the live vol product, works pretty good. iVolatility.com is still out there, and they have 1 day old data is free. So you can go to their website and you get some free data, I believe, on the CBOE website. They have some there as well. I think they contract with iVolatility. So the CBOE website has actually pretty decent free delayed data stuff. And comparing realized to implied, that's what the OX premium harvester thingy does. They're comparing realized to implied, and to try to help you generate trade ideas with that. So the stuff is out there. And of course, if you really want to learn how to do it, you will take a class at optionpit.com and learn how to do it, how old guys like Longo and I used to do it. So, and you could do some learning.
You got a few years on me, sir. Don't lump me into your category yet.
I can't lump you into the almost 50 category.
There we go. But there you go. A couple plugs for Andrew's stuff. Buy his software and then take his webinars. But seriously, we talk about live vol a lot here on the show. That's a good one. But I think the iVol plug is a good one as well, because you don't talk about them as much. And they are still out there. Surprise, surprise. And they do offer some great data. So surf on over to iVolatility.com as well. You can check out all this stuff. And they do have some free stuff available that is also pulled by some of the exchanges like CBOE and others. So you can find their data in a lot of places. And if you're looking for that, just want to do some historical analysis and back testing, that free data should do a lot of the job for you. And again, your brokerage platform, depending on who you use, should offer a very robust suite of tools in that line, like what the folks at OX have with their premium harvesting on the Idea Hub. Mr. Jared, anything you want to add here?
No, you guys covered, I think you covered the universe. There's maybe a few other software providers around, and I should put in a plug for people who learn programming languages. You can pull in a lot of data, free data from different sources in a script, and calculate the realized vol yourself, and get, in some cases, you can get implied vol other ways. So yeah, but you guys got, I think a good rule of thumb is if you're gonna get a software, buy something from a software provider, then that's great. But if you're not, then if you're going to trade options, you kind of have to be at a broker who's got some of those tools. Otherwise, you're kind of flying blind.
All right, great question there. Or Mr. or Mrs. Phillipono, we love to hear from you guys. We went on long again today. So much to talk about this week in the Vol Review. Only have time for one question. Maybe we'll do a listener mail palooza one of these days to get all you guys featured here on the show. But keep those questions coming. We love to hear from you. Meanwhile, we're going to have to pretty much put a capper on this episode of Volatility Views. But before we go, a little bit more spook here to kick off your holiday weekend here in style. Before we go, of course, let me check in with each of my cohorts here on the old Volatility Views panel. See what they have cooking that may interest you. Andrew, you've already unleashed a flurry of plugs. So is there anything else left in your plug quiver, sir? The floor is yours.
Oh my gosh, the floor is mine. I don't know what to do when I have a floor to myself. I think volatility, tough one. I think our range is going to be bigger, but if this rally holds, VIX will be trading in 13 handle next week.
Quite possibly, sir. I think we both were on the fence of that it wouldn't drop much lower than where it was last week. I think we were both proven demonstrably wrong. So there we go. That's what we get for going out on a limb, sir.
Get smacked.
Not as bad as Greenspan, though, so at least we have that in our favor. All right, Jared, take us home, sir. What's coming down the pike from BGC Partners? Some interesting changes going on over there at BGC these days.
Yeah, we're keeping everybody on their toes, and we started doing a daily note now that got picked up a few places this week in the media and seems to have been received really well. So if you're not a client and you'd like to be, get in touch. We can talk about that. Yeah, we're looking at what's going on in the market and the economy in something closer to real time, as well as keeping all the medium and longer term publications still on their regular schedules. So lots of stuff coming out these days. And in terms of forecasts, I should mention, I think I was neutral last week, relatively undecided. And that turned out okay.
Surprise, Jared, on the fence, sir. Surprise. You diehard
right?
Keynesian.
Make a call, Jared.
for next week, I guess there's a modest trend lower in vol. I guess I would ride that down, being short equity index vol this week. Although I have to, in terms of plugs, I will plug a chart I put together this week in China, looking at vol risk premium in China versus the U.S. And after a really quiet year and relatively lax premium pricing in Chinese equities, investors seem to have really turned on China, and as I titled it then, the grace period is over. So I think we might see more divergence among international equities versus the U.S. in the next several weeks. There's something, a pick I might be wrong about, and we'll follow it up on the next episode of Volatility Views.
There you
That's
go.
right, that's your job.
There you go. That's a good transition, sir. I think all this spooky music has gone to your head, sir, so we probably should cut it right there. On behalf of Jared and the Rock Lobster, and of course myself, hope we didn't scare you too much on this Halloween spectacular edition of Volatility Views. We'll be back with our normal show next week, listeners. And of course, thanks to everybody out there for downloading and streaming and subscribing, and of course for sending in such great questions. We'll get to more next week, I promise. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.